Imagine you have $100 million Canadian. You can only buy one Canadian stock, and you have to hold it for 10 years. No selling. No switching. No second guessing. Just one single position, and you live with it for a decade. It sounds like a simple question. But the moment you try to answer it seriously, you realize how much it forces you to rethink everything. Most investors focus on what looks good right now, the stock that has been trending, the sector that is in the headlines, the company that just beat earnings. But a 10-year hold demands something completely different. You need a business that is not just good today, but structurally advantaged in a way that cannot be easily eroded over time. Today we are going to answer this question seriously, with real numbers and real reasoning. And I will tell you up front, my answer changed twice along the way, and each change taught me something important about how to think about long-term investing. My initial instinct was Brookfield Asset Management, BAM. BAM is one of Canada's largest alternative asset managers, with over $1 trillion in assets under management. It invests across infrastructure, real estate, renewable energy, and private equity. But here is the thing, what matters is not what it invests in. What matters is how it makes money. BAM earns management fees. It is an asset-light model. Regardless of whether markets go up or down, as long as capital stays on the platform, the fees keep flowing. Profit margins are close to 46%. That is a remarkable number for any business, let alone one operating at this scale. And when you think about where the biggest capital flows are headed over the next decade, AI data centers, energy transition, infrastructure build-out across emerging markets, BAM is positioned right at the center of all of it. It is not betting on one sector. It is not trying to predict which technology wins. It is simply collecting the toll as capital moves through the system. That is a powerful place to be. So my first answer was BAM. But wait. After digging deeper, I realized I had overlooked something important. BAM has a parent company, Brookfield Corporation, ticker BN. BN owns roughly 73% of BAM. So when you buy BN, you are already indirectly owning BAM, and you get BN's own insurance business, private credit platform, and directly held assets on top of that. Think of it this way. Buying BAM is like buying one floor of a building. Buying BN is like buying the whole building at a discount. And the valuation difference is striking. BAM's quality is fully priced in, it trades at around 32 times forward earnings. BN trades at a meaningful discount to its net asset value, at roughly 8 times forward earnings. The historical returns confirm this. Over the past 3 years, BN delivered annualized returns of around 33.5%, while BAM came in at 20.1%. That is a 13 percentage point annual gap. Compounded over 10 years, that difference is enormous. It reminds me of a principle Buffett has talked about: the best business at a fair price beats the fair business at a great price. BN gives you a great business at a better price. Updated answer: BAM is out. BN is in. But I did not stop there. I forced myself to go back to first principles. If you can only hold one stock for 10 years, what is truly irreplaceable? Not just good, irreplaceable. I went back through all the major candidates on the TSX. Royal Bank of Canada, RY, one of the strongest banks in North America, but it is already fully valued at a premium multiple. Dollarama, an incredible operator with a genuine consumer moat, but expensive relative to growth. Shopify, enormous long-term potential, but trading at a valuation that prices in a decade of perfect execution. And then I came back to a name that the market has been quietly overlooking in the current environment: Canadian National Railway. CNR. CN Rail owns and operates a rail network that stretches across the entire North American continent, from the Atlantic coast to the Pacific coast and down into the Gulf of Mexico. And the case for owning it long-term comes down to 3 very specific reasons. Reason 1, the moat is physical, and it cannot be replicated. CN's rights-of-way, land parcels, bridges, and tunnels were built over more than 100 years, with capital that can never be fully quantified in today's dollars. No new competitor can reproduce this network in the next decade. Or the next 2 decades. Possibly ever. Think about what that actually means in the context of competitive moats. In the technology world, a moat can be eroded by a better algorithm, a cheaper cloud provider, or a regulatory decision. In financial services, a moat can be disrupted by a fintech startup or a policy change. But you cannot build a new transcontinental railway. The land rights alone would take decades to acquire through hundreds of jurisdictions across 2 countries. The regulatory approvals at the federal level in both Canada and the United States would face enormous opposition. The capital cost would be in the hundreds of billions of dollars. CN Rail is not just a great business. It is a physical infrastructure asset that cannot be recreated under any realistic scenario in our lifetimes. That is a different category of competitive advantage entirely. Reason 2, short-term pain creates long-term opportunity. Since 2025, U.S. tariff policy and broader North American trade uncertainty have put real pressure on CNR's freight volumes. The company even withdrew its medium-term earnings guidance, which spooked a lot of investors. The stock has been meaningfully suppressed as a result. But here is what is critical, and this is the distinction that separates long-term investors from short-term traders: this is external cyclical pressure, not an operational failure. CN Rail's network did not get worse. Its competitive position did not weaken. Its management did not make a strategic mistake. Trade policy created a temporary headwind. And even against those headwinds, CNR still delivered 1% revenue growth and 8% earnings per share growth in 2025. It raised its dividend again in 2026 by 3%, continuing a streak that stretches back more than 2 decades. The payout ratio sits at just 66%, which means the dividend is well covered and has significant room to grow. The market is pricing in permanent damage. But tariff cycles end. Trade patterns normalize. And when they do, CN Rail will be moving the same freight it always has, across the same irreplaceable network. This is exactly when long-term investors should be paying attention. Reason 3, cycle-proof, decade-long resilience. CNR's average return on equity over the past 10 years is 17.2%. Not a one-year spike driven by a favorable macro environment. A full decade of steady, compounding returns through multiple economic cycles, rate environments, and geopolitical shocks. Now compare that to BN. Brookfield Corporation is ultimately a financial holding company. It depends on capital market liquidity, investor appetite for alternative assets, and its ongoing ability to raise new funds across its platforms. Over the next 10 years, there will almost certainly be at least one severe credit cycle, one period where liquidity dries up, spreads blow out, and financial leverage becomes a liability rather than an advantage. In that environment, BN's structure makes it considerably more vulnerable than it appears today. CN Rail does not have that exposure. Railways do not need functioning credit markets to operate. Freight moves regardless of what is happening on Bay Street or Wall Street. Wheat still needs to get to port. Potash still needs to reach the coast for export. Lumber still needs to reach the mill. Consumer goods still need to move across the continent. The physical economy does not stop because the financial system is under stress. That resilience is exactly what you want in a 10-year hold. So the final answer is CNR, Canadian National Railway. Railways do not disappear. North American trade does not disappear. CN's rights of way do not disappear. This is what buy it and sleep soundly for 10 years actually looks like. And the whole journey of this analysis traces a classic evolution in long-term investment thinking. BAM, a great business with remarkable margins and global reach. BN, the same great business, at a better price, with more exposure. CNR, a great business, at a currently depressed price, that is also physically irreplaceable in a way that no other company on the TSX can claim. That final dimension, irreplaceability, is what truly separates the great 10-year holds from everything else. You can copy a fee structure. You can replicate a balance sheet strategy. You cannot build a new transcontinental railway. When you find an asset like that, trading at a discount because of a temporary macro headwind, the decision becomes straightforward. That is the CNR thesis in full. So that is the full analysis. BAM, BN, and ultimately CNR is the one Canadian stock to hold for 10 years. But I want to know what you think. What is your answer? Drop it in the comments below. I am genuinely curious, how many of you would go with Shopify, betting on the continued dominance of e-commerce infrastructure? How many would stick with Royal Bank, the safe and steady compounder? And how many would make the same call I did and go with CN Rail? Every answer tells you something different about your investing philosophy, and I read every comment. If you found this analysis useful, please hit like and subscribe. We publish Canadian market analysis every week, and the next video is already in the works. See you then. This video is for informational and educational purposes only. Nothing discussed here constitutes financial advice. Always conduct your own due diligence and consult a qualified financial advisor before making any investment decisions.